Welcome, everyone, to the Directed IRA podcast. This is Matt Sorensen, joined by the incredible Mark J. Kohler.
Thank you, sir.
And we are here today for you, the freelancers, the independent contractors, the people out there hustling, making money, that don't have a 401k. Your company never gave a match. There is no company. It's you. So we want to talk about how you should be saving for retirement.
You know, it's funny. I was talking to a freelancer the other day, and they were actually sad. They were like, "Yeah, I'm not an employee anymore. I don't have all these benefits and all this stuff." I'm like, "What? Oh my gosh."
People are dreaming to be you.
Oh my gosh, exactly. and that's from a tax and legal standpoint. I'm not just talking about flexibility in your schedule, the no glass ceiling, you can bill what you want, choose your clientele. That's all great. But from a tax and legal standpoint, and that's the message today, you can really do some cool things to save taxes and build wealth that the average employee cannot do. And so embrace this. And by the way, you're going to become an employee of your freelance company. That's kind of spoiler alert. Can I say that?
Yeah.
I don't know.
I mean, there's so many strategies we can dive into. We want to laser focus, though, in on retirement plans. There's what entities should you use? What tax strategies should you be implementing? There's a lot there. But we're going to focus on retirement plans that you should be considering and how to build and grow that long-term wealth. One thing we've noticed with people who are freelancers, independent contractors, small business owners, is they think their business itself is their retirement plan. And they just reinvest all of their money back into their business. And Mark even wrote a book about this, Business Owner's Guide to Financial Freedom.
Yeah.
We've seen that be a disaster for people.
Yeah.
Okay, we've seen that not work. Instead, you should be reinvesting in your business, but also setting some money aside. Retirement accounts have great tax benefits, and they're for long-term wealth building, because we want you to have like a retirement that you're looking forward to, not one that you're dreading.
Also, keep in mind another caveat. When we say retirement plan, we do not mean Wall Street products. Can I repeat that? So many people think 401k, I hate Wall Street. Me do too. We do too. And sometimes, I mean, I've got money in the market. But what we're saying is you need to know that your retirement account that we're going to be talking about today could be real estate, notes, syndication, venture capital, crypto, whatever you love. So get over it. We're not trying to sell you stocks, bonds, and mutual funds, although some of you may want that in your retirement. Yeah. You get to choose. Also, Matt, we got levels here. Can you explain that not everybody is going to be the same answer here?
Yeah, and I think that's the hard thing is there are some strategies that are a little more advanced, but you're a level 3, okay? Yeah. Some of you can go level 3 right out of the gate because you're like, I'm crushing it, I'm making great money. Let's hit me to level 3, Matt and Mark. Some of you are like, guys, I'm barely eking it out. I'd like to put some money aside, though. You might be a level 1. And then, of course, some of you in the middle, level 2. So we want to hit that, make sure you guys know what your account options are, and what's the optimal order of how you should be using those to be setting money aside.
Yeah, and I just want to hit the 70-30 rule, a very common financial principle that's out there is that at the very least, you want to be living on 70% of your after-taxable income. So this takes some planning. This is exciting because as a freelancer, you can sit down and go, okay, how much do I think I'm going to bring in this year? Okay, what's my estimated tax rate, fed and state? Okay, here's my real take home. Okay, I'm going to carve out 10% for maybe charitable giving or some a future savings account for something special, 10% for long-term retirement, and kind of another 10% for short-term type acquisitions or investments. It was Kevin Hart that did an incredible fun interview on YouTube where he's like, whatever I make, I say 50%, that's going to the IRS. I'm not even going to be thinking about that. That's
my money.
Not my money.
Not my money.
Then on this other 50%, I'm like, okay, I'm going to take half of that and go, that's not my money. That's my future. And I'm going to put it in real estate. I'm going to put it in retirement accounts, whatever I want. That's going to go over here. That's 50%. This other half, that's what I get to live on. Now, in the big scheme, that's 25%. He's saying, his income level, a little higher than most probably, but he's saying, I'm going to live on that 25% of my after-tax income. I'm going to get he started with his 100% income, 50% goes to the IRS, then that remaining half, he's going to go 50% to savings, 50% to living on. So it's more of a 50-50 rule after tax. So the point I'm getting at here is Matt really hit a vein. Over the years, took a lot of my profits and drove it right back into my business. I didn't peel off 10% or 20% or 30% and just put it in some other alternative investments. And I should have. And I regret that. so far the bet has paid off, but it's very risky because when I do exit some of my businesses, it will pay off. I'm still crossing my fingers, but it's scary. You need to have that other nest egg.
Yeah, and there's tax advantages to the IRAs and 401ks, and no matter what type of account you're using, an IRA, a 401k, traditional, or a Roth, when you put money in it and invest it, that money grows and you pay no tax on the returns. You keep investing it, you grow it, you make money. That account does not pay taxes, okay? It's building and growing long term. And so there's different benefits on a traditional. You get a deduction when you put it in. A Roth account, you don't. But on the traditional account, you pay tax on the way out. But on the Roth account, there's no tax on the way out. So there's some different perks here and different rules. We've got other videos and shows on what's a Roth IRA versus traditional IRA. But the general principle here I want to make sure everyone understands is it's tax advantaged. Okay, like I don't pay taxes as I'm growing it. Like think of you making money personally or investing it and you made $100,000. No, you made 70 after you pay federal and state taxes on it. Maybe it's long-term capital gains, some state taxes. Like now you're reinvesting 70. Well, if I can reinvest 100 and I make 100, every penny gets to keep growing and compounding. And that's building wealth for you in the future. So that's a unique benefit to retirement accounts.
Okay, now Matt, I know you've really articulated or put together kind of this level 1, 2, and 3 options for retirement account savings, but I want to just step back for 60 seconds and build the framework here. If you're a freelancer, you are a small business owner. If you're going to be making more than $50,000, which most of you listening are, you're going to be an S corporation or an LLC taxed as an S corporation. Spoiler alert, get over to our Main Street Business podcast and watch some podcasts or videos on the S Corp versus LLC, when, how, why. Once you're in that S Corp position, you're saving more in taxes, and now you're going to figure out that percentage. How much do I want to set aside for the future? How much do I need to live on? And how much am I going to reinvest into my expansion and growth and scaling? And it's going to change every year. It's going to vary, and that's okay. It could vary by quarter. But the big picture point here is know that you're a business owner. Know that you're going to have a structure, typically an S corporation. You're going to set up a payroll procedure for yourself. It's going to save you a ton in FICA taxes. And then you're going to start dealing with these percentage allocations issues. So let's just assume now that you're going to start peeling away 10, 20, 30% or more for the future. And the more money you make, the more you can put away. And the more money you make, the cooler the strategies. So level 1, Matt. Level 1, everybody should be doing. Period.
Level 1 is the Roth IRA. The Roth IRA, you can put $7,000 a year. And now when you put money in the Roth IRA, you don't get a tax deduction. The government's like, thank you for saving $7,000 for your future. We are not giving you a tax deduction today, but you've got a great deal. When you invest that money, there's no tax as you're growing and investing it, and it comes out tax-free later in retirement. It is a tax-free vehicle, okay? And so we want to get everybody started at first. Can you get $7K put away in a year? That's a little over $500 a month. Can I get that set aside? So for level 1, I want to make sure you can get $7K done. Don't move it forward here to anything else. Stay here until you can do $7K.
Yep, and put it on autopilot. Do auto withdrawals, set up that Roth account. Maybe you want to buy crypto with it and save invest using an alternative strategy at directedira.com. You can set up a Roth IRA right now. You could trade, you could do crypto, you could build it and pool it for real estate. And for many freelancers, they had an old job where they were W-2. They have this old 401k languishing somewhere that they don't even know what it's invested in. Bring that into the party. Bring it to the party. So you can pool that and start chunking away at it and turning it into a Roth. And now you're on an investment, and watch some of our videos on chunking Roth IRAs. We have a video on that. So take that old 401k and bring it to the party. And level 1, you're making around 50 to 100 grand a year. Yeah. If you're making 50 to 100K a year, you should be able to put away 600 a month. Get on that plan first, get committed to it, make it a habit, pool your old money, bring it together, learn a little bit. Stage 1.
Okay, stage 1. All right, level 2. We want to level up here.
Okay.
Level 2 is if you're making, let's say maybe you're making between 100 and 200K a year. we've assumed you've already done the Roth IRA. You've already done 7K, and you're like, I want to do a little more.
And you're already in the S corporation.
Yeah, and you'd be using the S corporation structure. That's going to save you self-employment tax. That's more money in your pocket, which, you know what, that could actually fund your Roth IRA entirely.
Yeah.
The savings on that alone could fund your freaking Roth IRA every year. Okay. That's free money there. That's the free money.
Yeah.
You know what I mean? That's free
Totally.
money right there for you. Okay. So now there's something called a backdoor Roth IRA. Once you start getting in higher income levels where you're making more than 146,000 single, 230,000 married, that adjusts every year. But that's what it is for 2024. Once you're making more than that, you need to start looking at doing what's called the backdoor Roth IRA.
Because you're going to hear a lie out there.
Yeah. And the lie is, you make too much money to do a Roth IRA.
And you know what I'm going to say? You're going to hear incompetent statements. Because a lie means they know better and they're telling you a fib. They're not telling you the truth.
True, yeah.
The reality is there's a lot of incompetent accounting and financial advisors out there that just take that face value. If you make too much money, you can't do a Roth. There's a backdoor Roth strategy. Everybody uses it. It's been around for years. It's honest, ethical. It's tax strategy that's well-founded in tax law. Get over to our other videos on the backdoor Roth strategy. So if you've already heard, well, guys, level 2, I have to give up on the Roth. No, you're going to learn the backdoor Roth strategy. Simple and easy. So here's the cool part. Level 1, level 2, level 3, you're building.
Yeah, you're stacking.
Yes. So level 2.
Level 2, we're still going to do the Roth. And again, if you might be over that high income level, it's just going to be a backdoor Roth IRA. And the same thing, it's $7K a year. Don't get a tax deduction, but it grows and comes out tax-free. Now we want to look, though, at doing what's called a solo 401k. Okay, a solo 401k is a 401k plan for you. This is specific for you freelancers and self-employed business owners, where the government has said, hey, we want to let you do a 401k. We know 7K is not enough for you.
Yeah. And you can do this on top of the Roth.
And you can do this on top of the Roth. And we know that if you worked in corporate America and you had a day job where there was a 401k, that you would have a 401k program where you could do $23,000 a year as an employee, and the company you work at could throw in some money too. Well, they offered this solo K for self-employed people. You could put $69,000 a year on top of the 7K of the Roth IRA. So I can put $69,000 a year into a solo 401k.
Yeah, now I want to, Matt and I debate things. So I'm going to say at level 2, what I want to say is the 69 topic to me comes into play on level 3, because now you're making enough.
Said up to.
Yeah. I know you got that. Everybody level 2.
Narrow it down for me.
Yeah. Let me just say, spoiler alert, that 69 number, that's going to come in level 3. But here's what I like at level 2. You're building upon your 7K. You're still doing that. Auto deposit. Now you're going to add the solo 401k, which is a $23,000 contribution. So now you're doing $30K a year. And when you're making between 100 and 200, you can say, all right, I can do that 23. Maybe I'll even do a little company match based on that payroll strategy you guys are talking about with the S Corp. So level 2 is I'm going to go from 7 anywhere to maybe 30, 35, and you get to choose. Yeah. It could be 7 plus 20. It could be 7 plus 10 or 15. But that first 23,000 can go straight in as Roth money off of that little S Corp strategy. The company could do a little match. And that's level 2. And and if you're married, you may even be adding your spouse in that level 2 level.
Yeah.
You're just kind of playing with it.
Yeah. And I think, and so you don't have to throttle to 69. I want to get to that here in a second.
Yeah, that's more level 3.
69,000. Okay.
Yeah.
What are we talking about here? Jeez.
No, we're making this really enticing.
Everybody's trying to get there very fast. You know? All right, slow down. Okay. 23,000. The reason Mark said that number is that's the employee contribution number. So you can put in $23,000 a year because you are the employee of your own business. And that if you made $23,000, you can put in $23,000. So it's really easy to get that first 23 in. And again, maybe you're making $150K a year and you're like, I've already got the 7K. I need to do another 10 or 20K on top of that. I can't just like drop in 69,000, but I could do another 10 or 20K. Super easy with the solo K. And this is the strategy where you can do the 10, 20. And maybe in 3 or 4 years, you're doing 40 or 50. And you keep building up of how much your earning potential is. And you're getting more and more money into the solo K based on your income.
Totally. And before we go to level 3, we got to stay here for a minute. There's some onion to peel away here. A couple other points. This solo 401k, if you choose to self-direct, which you wouldn't be on this podcast if you didn't have a little bit of insight onto the self-directing strategy, you get to be the trustee of that 401k. So now there's no financial advisor fee. You're setting this whole deal up for maybe $1,000 to $1,500, depending on, we do it here at the law firm. You've got this solo 401k. You're rolling in your old 401k from that old job. Now you've got this bucket, and you're the trustee of it. You could set up LLCs, go do real estate. We've got the crypto 401ks here. You could put them in syndications, do hard money loans. Now you're taking that solo 401k and really getting some kick-ass returns.
Yeah, and I think this is where people start getting excited about building retirement, because what we've noticed is a lot of entrepreneurs, freelancers, small business owners, they don't like Wall Street products. They're not excited about an annuity or an ETF or a target date fund in their IRA or 401k, but they're like, wait a second, I'm a real estate guy. That's what I do. That's in my business I'm in. You're telling me I can buy real estate in my 401k? Yeah, that's what we're telling you. You're not going to do that at a broker dealer like at TD Ameritrade, but you can do it with your Roth IRA here at Directed IRA. You can do it at your solo 401k that you're doing through Directed. Our law firm KK Soldier is setting it up. So these accounts are not, as Mark said at the very beginning, restricted to Wall Street. You can invest in a small business, in crypto, in a private fund, in a venture capital, in a startup. These are all assets that your IRA or 401k here we're talking about can own.
And we're so excited. Many of you may have just discovered this podcast and you haven't listened to any of our other ones. You're like, oh my gosh, these guys actually can walk and chew gum. This is interesting. Go back and please listen to the first 10 to 20 podcasts of our Directed IRA podcast series. We've got over 100 episodes now or more. And that first 10 to 20 really go through the basics. So don't get overwhelmed. Just know it's there if you want to go check it out. Now, here's another cool feature of Level 2. You can say, well, hey, I've got a knack for options and ETFs and S&P 500 funds that I really like, and I really like my portfolio on Wall Street. Keep it. That's great. You can have the IRA doing one thing and the solo 401k doing another. You can do two different things in the solo 401k. You can keep your old 401k and do things. Sky is the limit. And this is where doing a consultation with one of our tax lawyers on the law firm side, what we call a comprehensive consult, they can look at your overall picture. We call it a trifecta. What do you have in real estate? What do you have in life insurance? What do you have in the market? What do you want to do with your small business? Is your S Corp as efficient as it should be? They can do a plan for around $1,600 to $2,000. We have different levels there because depending on the complexity of your life. And start with a comprehensive consult and go, oh my gosh, this is pretty cool. Take it to your accountant. Take it to your advisor. You don't have to fire everybody. Get a second opinion. And that's what we've been doing for years and just growing at exponential rates.
All right, let's talk about going to Level 3.
Okay, is there anything else in Level 2 you can self-direct? Oh, you could add your spouse in Level 2.
Yeah, you could add your spouse, and they need to be actually working in the business, and then you do need to put them on payroll. A lot of people are like, should I add my spouse on payroll in my small business? I'm like, only if you need to. Like, don't automatically do that because you think they need Social Security or something. We've shot other videos about that. But if you're like, no, I want them to start putting some money away in the 401k, now we see a good reason to add your spouse onto payroll.
And let's get real. See, before you even go to Level 3, you can double down if you are married. And typically, if you don't have a prenup or something odd, it's going to be a marital asset anyway. So when you're combining as you and your spouse and putting money away for retirement, you're really doing it for both of you, and you're getting more bang for your buck in an efficient way with not a lot of headache. So Level 2, for those that are married couples and a marriage that you're planning on, building upon, stay here for a minute. Really learn what you're investing in. Really eke out and bring everything you can out of Level 2. Yeah. And it really is, because your spouse may have their own side hustle. They may have a day job and a 401k. You can have both.
Yeah.
Super cool.
Yeah.
All right, Level 3, 200K plus.
All right, Level 3. Yeah, you shouldn't really be hitting this one unless you're 200K plus, and it might even be 300K plus, depending on, your living expenses, lifestyle, yada, yada. All right, you're making at least the 200K. We want you to still do Backdoor Roth IRA. That's not off the table.
Level 1's still going.
Level 1, we're still Level 1, and I want you to still do that 23K is the employee contribution. But now there's a little extra thing you can do. There's two options you have here. I'm going to lay it out in two options, okay? One is you can just do the match, okay? Depending on how much you're taking in your W-2, which you should have an S corp if you're making this much money in your small business. Okay,
that's a no-brainer.
You should have an S corporation, which means you're getting a W-2. You can take 25% of whatever the W-2 is, and then make an additional employer contribution. See, when you have a solo 401k, you're the employee in that business, but you're also the employer. You're both, right?
Yeah.
So the government's like, well, we'll let you put money in as the employee plus the employer. So I did my $23,000 as an employee. That's the max. By the way, if you're 50 or older, you get to do another $7,500. But now I get to do 25% of whatever my W-2 is. Let's say your W-2 was $100,000, just so I can do the math easy. Okay. That means I got to throw another $25,000 on top of the 23. Now I'm at 48. Wow. In contributions.
Yeah. In fact, it's even now. Some of you might have said, "Whoa, whoa, whoa! Where's Waldo? That went a little fast." Let's back up, and we'll go through this again. Level 1, you're putting away $7,000 if you're under age 50, $8,000 if you're 50 or older. Level 1. Level 2, you're like, okay, I'm going to be using the S corp, obviously. Gosh, I can't emphasize that enough. And if your accountant is all jacked up on high salary and you got to do reasonable comp and they got to stick up their butt, please get a second opinion on that. You accountants out there, check out my Main Street Tax Pro program where I stand behind all my reasonable comp strategies and advice and CE classes on this topic.
Approved by the IRS.
Approved by the IRS. Level two, you're going to at least put yourself on payroll and do $23,000 if you're under age 50, $30,500 if you're 50 or older. Remember, that's level 2 on top of the 7 or 8. So now, if you're under age 50, you're putting in $30K. If you're over age 50, you're putting in $38,500. Wow. Okay. Now, level 3. Is this okay to summarize? Level 3, Matt says, now let's do that match. So if your salary is $100, now we're putting another 25 on top. Oh, you got your spouse in the mix. Woo! Oh my gosh, right? So you're now leveling up. And this is where this other figures start to come into play. The $69,000, and if you're over age 50, it gets to be 74,
76,
76.5 on top of level 1. So this is where you can start to really throw down, and it's insane. It's so fun.
Yeah, and the nice thing on this, and this is kind of a new rule, is that can be all Roth dollars. So if you want, so now some people are like, all right, Matt, now I'm making $300K a year now. I want tax deductions more. Yeah. I'm in like the 39% tax bracket now, or 37. What's the highest? 37?
Yeah, 37.5.
Yeah. So I'm in the highest tax bracket.
37. I apologize.
Yeah, I got state on top of it. And so Roth, I love Roth, and I love that when I was in a 20% tax bracket. But now if I go traditional, the deduction's twice as much. And I get that. Yeah. So when a lot of clients, particularly now as we're starting to approach year end, that we start kind of looking at year end tax planning here in the last quarter of the year, it's like, all right, I need tax deductions. Well, you might be like, I just want to take traditional. I could, that number I gave you, $23,000 plus another $25,000 in the match, you could do all traditional. That's a $48,000 tax deduction this year. Yeah. Your $300,000 of income went down to $252,000 of taxable income. Or you could go Roth. See, this is where you get options. And you'd be like, no, I want to build it and do it all Roth, which you can do. The match can be Roth. This was a change in 2023. The match used to have to be traditional, but now the match can be Roth as well. So a lot of cool options out there.
Yeah, no, I love it. And so we have termed this ability to create this massive Roth account for you and or your spouse, the mega backdoor Roth. Because again, your income's high, so we got to go to the backdoor. Because you'd want to walk in, you all want to be in the frat party. What's the name of the frat?
Kappa Kappa Gamma?
No,
I don't know.
No, Kappa Kappa Roth.
Kappa Kappa Roth, that's right. Phi
Kappa Roth. One of your jokes.
Phi Kappa Roth. I know, I forgot.
Phi Kappa Roth. I was teeing that up for you. So you want to go into the frat party.
You've seen me play golf? Yes. It's terrible.
Yeah. Phi Kappa Roth, you want to go into the front door. You make too much money, you can't come in. But we know the Animal House backdoor. You're John Belushi. You're going to walk around the back door and get into that Roth party. You want to be in that party, and then you want to double down. So that's where you're in level 3 doing what's called the mega backdoor Roth, which is this 69 or 76.5, depending on your age, times 2 if you're married and you want to go there. So this is where we have the influencers on YouTube, the freelancers, the really successful business owners, the professionals that are finally in the latter end of their career, and they're making that 500K plus. So they're the 1% of the 1%ers. And we're grateful for it. We're glad, we're happy for you. We're not, dissing on you like some groups might. We want to help you put that money away for the future, bless your family, your legacy. Let's get there. And so that's level 3, which you might, and so we got videos on the Mega Backdoor Roth and podcasts on that.
Yeah. So I think that's the roadmap. And so I think for everybody, you want to decide where you're at. Are you in this level 1, level 2, level 3? It really comes down to what's your income and what are you willing to set aside to start contributing. But I think the clients that we've seen that have success are the ones that have the discipline for it. And there's really 2 components to it. I think there's really 2 components. Because we have clients, like largest client, $400 million Roth IRA, guys. Like that's insane. We have I have a few others, 100 million plus, and a lot over 10 million. And I think a lot of people are like, how did they do that? 2 things. They consistently put money away, and they invested it very well. Now, this over here, everyone can do. Everyone can have the discipline to put money away. Now, it might be your level 1, but you can have the discipline to at least do that. The next one is a little more different, but I'm telling you who has the most success: entrepreneurs, freelancers. They're self-directing. They're not going and buying in a mutual fund or an ETF. They're self-directing. They're investing in real estate. They're investing in private companies. They're doing private money lending. They're investing in crypto. They're investing in the things that they know that can get a better return than being in a crappy mutual fund or in the stock market. And that is how they're able to grow and get exponential returns where they're in the tens of millions, hundreds of millions of dollars. So those are the 2 ways you need to be successful. We want to give you the 3 levels here so you know where to get started. And I love what Mark said earlier. There's a lot to this. Go back to the first 10 episodes, learn about self-directing, because once we get the money in and you've got these contributions and these numbers and we've talked about, and you've done it for 3 or 4 years, you got to be really good at making the investments. We want to get invested in stuff that gets you excited, that's going to good return, and that's going to build and grow your IRA.
Yeah, I love it. And the last point I'd make, and I'm going to take a dig at it, and we've got to get our show done on this. The nice thing about this is you can turn the tap up or down depending on how the year's going. I understand that freelance income can be volatile, right? One year you're killing it, the next year it's down. Market conditions, industry conditions. So the beauty of this is you can dial it up or dial it down, continue to self-direct and invest. Life insurance doesn't give you that option. When you're going to get the pitch. Let me just tell you right now, you're going to get the pitch, come in and buy this big old life insurance policy, which technically creates some wonderful tax-free income down the road. There's some great strategies there. It technically works. And there's nothing wrong with adding some life insurance to the mix. But to us, that's kind of comes after, and maybe we're a little jaded, but I like the flexibility of turning the tap on or off and adding life insurance when I have the stable income to support premiums. Because when you do life insurance, you got to support that premium hell or high water. Go that route, look at life insurance, be careful to choose a life insurance premium strategy that no matter what happens, you can maintain. With this, the beauty is you can dial it up or down. You've got your life insurance strategy over here. You've got your real estate rental strategy over here. You're bringing together several strategies at bear to really build that American dream. And we get that. We're not all in one box.
Yeah.
So
that's a wrap, man. I think we nailed it. I mean, I liked it. I hope you guys liked it. Subscribe to the podcast, the channel, wherever you're at right now. And go check out directedira.com. That's where we're helping clients across the country. Maybe you need a solo K. Maybe you need an IRA. Our team can certainly help. But whatever you do, take action, because this is your retirement. It's one you get to look forward to or one you're going to dread. And the size of your retirement account has some impact on that.
Love it. All right. Thanks, everybody. See you next week.